So I'm about to make y'all famous. Welcome to Friday Night Lights. We run this call every Friday night. So if you're new, welcome. We do this every Friday night, 7 p.m. Eastern Time. The call started about a year and a half, almost 2 years ago. We started the call off really to try and give back. There were so many groups out there. They charge money, they charge fees to join their clubs, etc. And we wanted to offer something that you guys could come to and learn from our mistakes, our successes, things that we've learned, and we really want to try and pay that forward and give that out. And so we started this uh, just for that. And over the last year, we've kind of morphed the whole thing into really trying to bring more value to you. So over this past year, we actually were working on a deal as part of our fund. We were closing a 106 unit property in St. Louis, and we walked you guys step by step each week what was happening as we were working through the deal and giving you guys insight, more of the details rather than a 10,000 foot level. We've also bring on special guests all the time to kind of really bring their perspective and the insights that they have. And so today I'm really excited to have someone else, TJ Wall. He's a broker for MMG. He's going to be giving you guys some insights on the market, as well as some information on how to really talk to a broker. So, we'll work all that in. Just remember, this call is really for educational purposes only. We are not financial advisors, SEC lawyers, tax accountants, and so you always want to do your due diligence in anything. I always have to give this disclaimer. But excited to have TJ on, and I will turn it over to TJ to kind of give more of an introduction about yourself and what you want to talk about today. So, TJ.
Absolutely. Well, first off, Jason, thanks for having me on. And thank you to everybody on the call for donating some time here on Friday night and ending your work week here with me. So honored to be on this call and sharing some time with you guys. Definitely want to make sure to bring some value. As Jason talked about already, I'm going to focus mostly on market trends here at the beginning, give you some broker perspective on what's going on out there in the market and what most recent trends are looking like from cap rate perspectives and what buyers are doing in the marketplace today. And then also we're going to spend some time going over CRE brokerage and just interacting with commercial brokers like myself. There's definitely common mistakes for folks new to buying commercial properties that we can put out there and just give a baseline on value of what brokers can do for you and what we typically don't do in the commercial space because it is a different expectation level generally than residential, like many folks are used to. Uh, so I'll start off a little bit by going into my background. I'm TJ Wall, the managing director, actually one of two. I have a direct business partner here in Kansas City, over the Kansas City market for MMG, which is our home market. I have been a broker now for about 8 years. And before that, I was actually born and raised in the brokerage world and in the multifamily ownership space. My first high school jobs before I could drive were going and mowing properties and trashing out multifamily units. So I got to do the fun stuff from the start and really, truly did grow up around the business. The last 3 years, 23, 24, and 25, Harry, myself, and the rest of the Kansas City team have led the multifamily market in Kansas City for total transaction volume. In 2025, that meant a little over $500 million in transactions and another 250 or so year to date, bringing us to around 750 million in the last 15 months. So we're active in the market. We're seeing action really across states as well, even though Kansas City has become my primary day-to-day focus. I've actually closed in 15 plus states now and do weekly calls with the entire MMG team in which I get updates from brokers across the different markets. And so I really do my best to stay in tune with what's happening, not just in Kansas City, but across the country. So first off, I'm going to start with what I would sum the market up with in 3 words, which is flight to quality. right now, buyers want quality. The deal on the left there, AI generated asset, that certainly is what some people were diving headfirst into 3 or 4 years ago when there was low cost, non-recourse debt options through debt funds where you could go and really lever up and go try to do really aggressive value add plays. That is becoming a thing of the past. Fast forward, you're seeing a lot more groups chase deals like the one on the right, which is Union Berkeley, which we sold in Kansas City last fall. That was actually the largest transaction in Kansas City history for a single asset at 113 million bucks. And that was a good example of the market getting aggressive for the newer, nicer product in good locations and setting a new high watermark for Kansas City, even in a little bit higher interest rate environment than we were in a few years ago. So that's a real time example of the flight to quality. I do think this picture's, you know, it's purposely setting the two extremes to show you guys the two extremes. But in all reality, it's not just asset quality that is what I mean when I talk about a flight to quality. It's quality and other factors that create safety and investment as well. It's a flight to stable markets, to the Midwest a lot of the time, as opposed to Sunbelt markets that have less stability, even though they were more explosive a few years ago. It's also a flight to more quality immediate neighborhoods. We're going to talk about the difference between A and C quality neighborhoods, as well as physical assets here in a minute, and what that means for cap rates, et cetera. And it's also a flight to stable in-place operations. Groups are very heavily focused right now on the in-place operations of a deal they're buying in a lot of cases. There's still deals out there that are being bought at really low cap rates and being looked at as value add plays, but there's no doubt that there is a much heavier burden put on the in-place operations right now at an asset than there was a few years ago. So diving right into a couple case studies here, I'm going to go left to right on what I would describe as a true C asset play in Kansas City there on the left with Blue Ridge Place all the way to an extreme Class A deal with upside in a main and main location there on the right, residences at Prairie Fire. And I'm going to give you the case studies for all three of these deals and talk about how they traded. All of these have traded with our team in the Kansas City market. So all the same metro within the last 6 to 12 months. And Blue Ridge Place is where we'll start. We'll start on the C end of the spectrum. So Blue Ridge Place had just over 10 offers. I want to say there was 11 written offers. And that's a low bid count right now in Kansas City. It's a very attractive market to the marketplace because it is a stable Midwest market. And we'll get into that a little bit more in a few slides. But generally speaking, groups want to be here. So even on a less demand deal, that's a C product in a C location, there was still 10 plus bids. But it wasn't the 20 plus bids we're going to talk about in a second on some of these other deals on the screen. So at the end of the day, where pricing shook out there was an upper six cap on in-place financials and in the mid 60,000s per unit. So you got a really low price per unit relative to other trades in the prior few years leading up to last year and now. And you also had an outsized cap rate compared to what we've seen in the market the last handful of years at an upper six cap. So that starts to make sense for folks. And that's what groups are looking for a lot of the time right now is the right balance of cap rate and price per unit for whatever type of asset they're buying. And there's groups with varying different business plans where they'll chase heavier lift C product. They want really heavy cash flow, or they want really heavy value add. All those things are going to affect what each group's individual desire for a price per unit or in-place cap rate is. So go to the middle deal here. Fiesta Square. This was a 70s built asset. Blue Ridge Place on the left was 60s. Fiesta Square was a 70s built asset in Johnson County, which is the highest end demographics in the Kansas City metro. So really good location here in the middle property, but a little bit more questionable quality of physical asset being a 70s vintage property. It was also being sold with two 80s assets in the same portfolio. I'll talk about the cap rate differences there in a second. But despite it being main and main in a very good quality location here in Kansas City and having a lot of upside, it was a majority classic units. Uh, didn't have a lot of deferred maintenance for a 70s built asset. Pool was as cleaned up as it looks in the photo. The exterior is fairly clean. And although the interiors were relatively classic condition, they were in good shape. And so that asset, uh, because of its location and with the scale of the other two 80s deals that were with it, actually had over 20 bids on the portfolio. It was very competitive. But even with all that activity, the cap rate on that 70s deal was an upper five cap. And we'll talk about cap rate on Prairie Fire here in a second, the really nice Class A deal on the right. That was all the way in the mid fours. So you're talking over 100 basis point cap rate difference still because it was a 70s asset. The two 80s assets that were in that same package traded in the mid fives on cap rate. So you've got a very different uh, cap rate variance as the age of an asset changes because groups have really flocked to the higher quality of real estate. And then looking at residences at Prairie Fire there on the right, it was a 435 unit asset, very well located in Kansas City. 2014 built, still had upside on it. Really, truly one of the best corners at 135th and Knoll that you could buy real estate on in Kansas City. And that deal ended up having an extremely high amount of activity from a tour perspective, from a bid perspective. And cap rate ended up shaking out in the mid fours there on the T12 from a fairly sophisticated operator too. It wasn't a seller where they were operating at a very outsized expense load. Although the buyer did trim expenses some, it was not a situation where trailing operations were driving that cap rate down. Uh, so that's a quick summary on the delta between a C and an A asset in Kansas City. That delta is very similar depending on what market and major metro you're in, but the actual figures might change a little bit. Most metros, a mid four cap's just not possible right now. But Kansas City, Indianapolis, Columbus, some of the really sought after markets are seeing that in the best product of their markets.
Well, and
So,
it's funny.
yeah, go ahead.
Fiesta Square, we were actually one of the 20 bidders on that one.
Yeah,
So
that's right. Yeah, and I think
we
Tim,
made
did
it
you
the
tour
best
that
and
one with
final.
me?
Tim did it. Yeah, Tim toured it. Yeah.
Yeah, yeah. So did Justin. Yeah, we made it to best and final on that one, and
Yeah,
they ended up going with the group that offered on all three properties instead of we were just offering on the one. So
correct. That was a big factor. And I guess another quick side note on that was they bought all three assets, and Fiesta Square and Residences at Prairie Fire did both have non-refundable earnest money day one on those contracts. So when you get into these really aggressive, high demographic submarkets in the Midwest right now, you're actually seeing non-refundable money come back into play. That did disappear a little bit for a couple of years there. So that's another quick factor to note. I'll jump in. We've talked about cap rate on the case studies here, but to give you a real visual of how cap rates have changed. Our analysis team and research team put together this chart of cap rates from January of 2021 and all the way to, I guess, April, so not quite now, but the end of last month, basically, on the cap rates of deals we've sold as a platform at MMG. So this is across the country with a heavy focus on the Mountain West, Midwest, and Southeast. We're typically playing in secondary markets, i.e., the Kansas Cities of the world. Yeah, we have an office in Denver, Louisville, Kentucky, St. Louis, Missouri, Des Moines, Iowa, Omaha, Nebraska, Northwest Arkansas. Those types of markets are our bread and butter. And so this is very reflective of those cap rate trends in those markets across hundreds of deals. And you'll see on the left there in January of 2021, the gray trend line, the dash line going across your screen there. Here, I'll grab the laser pointer. This gray trend line that's more linear here is really what we're looking at here because it shows you what's happened in the marketplace on a more evened out level. Because if you look at just this chart, the obviously the cap rates are all over the place because one month we might be heavy in C real estate. One month we might sell one big value add deal, right? That skews that entire metric for the month, right? So we've tried to even it out with that trend line. And here, one second, I got to get. Are you guys seeing the slide anymore? Did it drop?
We see all your slides now.
Yeah, here, let me click back in for you. Did that fix it?
Yep, you're good
There
now.
we go.
You're back with
Okay.
cap trends. Yep.
Sorry, I tried to turn the laser pointer off and gave you a different view on that.
Technology.
Yes. But anyways, so you'll see that trend line there. It trended up from all the way down at almost to a 4 cap back in January 2021, up to roughly a 6 cap as of late. That spike at a little over a 7 in April was because of some student housing transactions. That's not really reflective of where the market's at today. That trend line setting to about a 6 is probably more reflective across all quality of multifamily across varying markets. Somewhere around a 6 is very common right now. Which is reflective of groups wanting a spread somewhat above their borrowing interest rate on long-term debt, which long-term debt is sized off of, generally speaking, U.S. Treasury bills because it's agency loans typically that are financing these larger multifamily projects, as many of you know. And so what that light blue line there across the bottom is what the 10-year treasury rate was along this timeline. And so you'll see that there was roughly a 200 basis point average above the 10-year treasury really throughout history, but especially during this timeline. And you're seeing that it's normalized to about that spread today. When interest rates first jumped, cap rates didn't quite jump as much as interest rates did. So that spread tightened for a little while, but it's really normalized to about that 200 basis point spread on cap rates over the 10-year. It's a rule of thumb, but it's a very good reflection of what the market has historically done and really shows that we're entering a more normalized market, generally speaking. So jumping to why are we on this trend and what has happened to get us here. Obviously, T-bills going up. That's another shortened, abbreviated chart of the 10-year treasury movement there on the left has made a huge difference in cap rates. It's been a big driver in the market, and a lot of the flight to quality has come from cap rates going up and exits becoming harder to find for folks that bought at a really low cap rate. They cannot exit at a profit anymore because they underwrote exiting at a higher cap rate, at a lower cap rate than what's available today from buyers in the marketplace. And that's created caution. So that's one driver. You've got markets like Austin that a lot of groups were buying heavily in because there was net migration. And there was a lot of positive trends that made folks attracted to Austin, Phoenix, and many other Sunbelt markets. And they went to these markets, and now vacancy has shot up in those markets because so many groups put capital in. We're doing developments. There's now oversupply that's actually outweighed the positives of net migration, even driving down rents to a point of negative rent growth in a lot of those markets. And so that has scared folks away from markets that are less quality. And by less quality, I mean less stable, generally speaking. They might, Austin's a great city, but the metrics and fundamentals of multifamily there right now are challenged. And that's true across many of the Sunbelt states. So that's another thing that's driven folks to the Midwest and other more stable markets. You've got Phoenix rent growth there on the right. These are just two headliner markets. You could say the same for many Florida markets, many Texas markets outside of just Austin, even Denver reflects a lot of these trends. And so, Phoenix has actually had rent decline in some cases, and in some submarkets, you'll see in this chart, it's gone basically to 0% as of right now. And if you underwrote 10+% rent growth when you bought your deal, you're probably not succeeding on your business plan, which has been another deterrent for groups continuing to play in those markets and driven them to more Midwest cities. So that has driven many folks to seek quality in market. Jumping across, what markets are buyers most active in? Obviously, I've touched on this already a little bit. People are moving from the Austins of the world, seeking safety in the Midwest. I've got Kansas City up here, but this is also true for Des Moines, Omaha, Lincoln, Nebraska, even, or Lawrence, Kansas. I think maybe some of the folks on this call have even looked at deals in Topeka, Kansas, or Lawrence with me, or even Columbia or Springfield, Missouri, because they're stable markets, even though they're not as big as some of these headliner markets. It's driven folks to Indianapolis, to Columbus, and it's just changed what the most attractive investment markets are, as a lot of those markets that were booming a few years ago have started to bust. And so that's certainly a huge trend as well, and where most buyers are starting to look. I'm going to touch on why Kansas City next, but everything I say about Kansas City here is very true fundamentally to many other Midwest markets. Again, it's the one I'm the most knowledgeable on. And by the way, if anybody on this call, following up on the call, wants intros to get similar stats to what I'm providing for Kansas City for other markets, I'm happy to make the intros to the MMG folks that are in other markets as well. So why Kansas City? Low vacancy, even with some supply and winter leasing season being softer in Kansas City, which it always is. You'll see that our trend lines have still kept up well above 90, dipping down to 92, but we're really being pulled down by a few select submarkets with some extra deliveries, as well as a couple softer like C pockets in the city that have started to see vacancy. So this, in a lot of our quality suburban pockets, you're actually seeing average occupancies much higher than 92%, and still seeing buyers underwrite to 95% occupancy in most quality submarkets in Kansas City. And we also have had consistent rent growth. We're well above a 1% at this point. And even in some submarkets that don't have the challenges of some of the ones I mentioned that are pulling down occupancy, we're seeing rent growth as high as 5% in certain submarkets. So there's plenty of rent growth here, plenty of safety, and that has continued throughout this part of the cycle. Not to mention the few parts of the metro, the few submarkets that are getting oversupplied and have a lot of units coming online, still have really strong demos and growth patterns to help fill up that supply. And you can see an end in sight to that supply. There's not so many deals in the pipeline being developed that there's not an end in sight, and absorption's still strong. So we do expect those to fill back up quickly. In some markets like Austin, there are groups that are trying to look at those markets to buy because they think strategically Austin's maybe towards its bottom, but they are looking at those trends and absorption's still not there. So it's hard to commit to where the bottom really is in a lot of those other markets that are facing supply challenges. So in a market like Kansas City, when you can see an end in sight, even in the most oversupplied submarkets, which oversupplied is probably not even the right term for them, and just the higher supply submarkets, you're able to get comfortable there because the end is in sight, and there's not so many permits being pulled that you won't be able to absorb the vacancy. So that's a quick rundown on Kansas City, what we're seeing across the country. And I'm happy to get into some commercial brokerage talk here in a second and how to host conversations with brokers. But before we do that, I want to give a little bit of time to have a market discussion here, and really open the floor to questions from the audience and add value any way I can on the market side as well.
Yeah, this is awesome. So who's got some questions? Come on, I know you guys, last week we had a ton of questions, so
I have a question.
Go for it, Garth.
Yeah, so I understand right now Kansas City is very stable. But how do I predict on my exit in 5 years that it's still going to be stable and I can have a cap rate that's consistent, or even 100 basis points lower than my in place?
Yeah, this is awesome. So who's got some questions? Come on, I know you guys, last week we had a ton of questions, so go for it, Garth.
Yeah, so I understand right now Kansas City is very stable. But how do I predict on my exit in 5 years that it's still going to be stable and I can have a caprate that's consistent or even
Yeah. So I'll take the back half of that question first. And that is most folks are that you'd be competing with on the buyer side are not underwriting a lower cap rate on exit. Maybe in line with where they're going in because of strong fundamentals if they're leaning in. And then, some more conservative buyers that maybe are leaning in other ways will still stress the cap rate on their exit and actually even build in a slight buffer. So you don't have to compete necessarily with folks that are expecting cap rates to go down, although there's certainly people who believe that they will in Kansas City and in other markets. It's not necessarily the norm in underwriting. And so to get comfortable with staying at, relatively a neutral future cap rate, there's several ways to do it. One would just be looking at current market fundamentals, looking at the supply pipeline in and around the asset. And if you're looking forward, which naturally you're looking for a forward prediction, so you might be looking forward, uh, you're going to see that supply is not expected to ramp up. There's no uh, supply future stress in most Kansas City submarkets. So, and this is true for most Midwest markets. It's so hard to make deals work right now from a developer perspective that, most developers, you can't just go oversupply the market. There's not enough incentives available anymore from local municipalities. The borrowing costs are still high for bridge loans and construction loans, much higher than long-term debt. So that's keeping supply at bay. And so there's several reasons that you wouldn't expect any changes to the negative in long-term operations in Kansas City. And then beyond that, there's diving into what do we expect interest rates to do? And no one has a crystal ball, but generally speaking, I think most folks, although there's a lot of noise in the market, don't expect a significant rise in interest rates here over the next few years. And if that's true and interest rates hold generally level and fundamentals in the market continue to stay level, that's generally a sign that you can predict a similar exit from a cap rate standpoint. Uh, and look, you're buying into a market that's already actually had some cap rate expansion in the last few years. I mean, we just showed the chart of, you know, 200 basis points, almost an average cap rate expansion over the last 3-4 years. And that gives you a lot of support, right? Cap rates have been lower here in the past, in recent history. So several ways to get comfortable there, but I think those are the most common thought tracks for groups out there.
Thank you.
Question. Yeah, go ahead. Deontay, right?
Yes, yes, sir. Yeah, TJ, thanks for hopping on this evening. I've got a question that kind of connects back to that portfolio case study that y'all had. I'd submitted an LOI on a portfolio of 3 properties at the beginning of the week, total 155 doors, about 70% of the asking summed across of the 3. The broker rejected it, said the other offers were already in that were well above, didn't find it forthcoming for either of us to do a counter. Is there just something that I'd missed in that? Or is it, I know one of the homages is the best deal that you do is the deal you don't do. So to not get stuck with it. But what's your take on that?
Yeah, it's really hard without seeing your exact underwrite. Definitely happy to have an offline conversation too about specific assets. But just at a high level, if you think about business plans, a lot of times we'll have one group that is the top bid on a portfolio that seemingly seems very similar to something else we're taking out. But for whatever reason, the in-place cap rate's different, or maybe there's existing debt on one or the other, and different business plans underwrite different metrics. And so if you're a very IRR-driven buyer, you may pass on a deal that's for more of a cash-on-cash driven buyer, right? And vice versa. If you're focused on cash, maybe someone else was seeing a path to a higher IRR, pushing rents, or has a different debt solution that's pushing up their IRR, whereas you were stuck focused on the cash metric potentially. It's hard to say for sure, but certainly, and we'll get to this in a minute. there's a lot of deals that come out, but also not that many, right?
Right.
There's plenty of deals in the sea, but at the same time, there is also a limit to the deals that launch each year. And so there's patience required. You're gonna have to just keep chasing and find the ones that fit your business plan. But sticking to your business plan is generally the right choice, right? You find the metrics that work for you and that you're focused on, and eventually a deal will come that fits those. So
Definitely. No,
that's my quick
appreciate
feedback.
that response. And to kind of further build, I think you kind of pointed in this direction with respect to offering for full portfolio versus one or an individual property of the portfolio. Does that generally give you a little bit more leverage or negotiation power?
Very seller dependent. So the three pack case study there, yes, that was definitely an important factor to the seller because they were doing a reverse 1031 exchange, which they did do on that asset. So they took the equity from those three deals, and that was a reverse 1031 for a larger single asset that they bought. So for them, transacting all three at once and having that timeline work was crucial. Uh, we've also sold for a group called Canyon View Capital. We sold a couple deals for them in Lee Summit. Very similar deals. They're both 80s assets next to each other in a good pocket of Kansas City. And there was a couple portfolio bidders that could have taken down both, and they just ended up getting split up because bids were slightly higher on each individual asset, and different groups favored one or the other for various reasons. And that seller was focused on pricing, and it didn't matter if they got split up. So that's very case by case. And if you're close enough with the broker that's listing the deal, especially as you get close to call for offers, they probably have a feel for if it's going to be split up or not. And hopefully they're honest to tell you if they have no idea, because sometimes it is hard to predict. But getting a feel from the broker and asking them the expectation for whether or not it's going to be split up and what the motivations are is certainly an appropriate question in cases like that as well.
Gotcha. Thank you so very much. I'll drop my details in the chat.
Yeah, perfect.
Okay, great to be here. Quick question. I work with a lot of clients, and they keep asking me, what would be some great questions to actually ask a broker in sequence? And probably a lot of people have different questions, but I would like to know, what is the question that most people don't ask that they should be asking a broker?
Yeah, it's a good question. A lot of folks ask in different ways, seller motivation and reason for selling. But a lot of folks skip that, or they wait really far into uh, the actual offering process to ask that question. And it's a very appropriate front end question to help you understand what the seller's business plan was or is, and how that might fit in or not fit in to your business plan. So I'd say that's probably one of the most commonly overlooked ones because a lot of the other questions are very obvious. They're metric based. You're looking at an investment opportunity, right? So you get a lot of different questions that are fairly obvious around the actual investment opportunity, but asking about the story and understanding the background and the future for the deal is a lot of times the most important question, and generally isn't an uncomfortable one to ask. It may feel like it as a buyer, but it really is not. We're used to being asked that. So I would say that's probably the most important.
Great, thank you.
Well, along those lines, TJ, how often do you get asked the questions, what do you not like about the deal? And how do you feel about answering that as a broker?
Yeah, it's fine to answer as a broker. I mean, you can usually most deals wear their problems on their sleeve, right? And it's probably already priced in to the guidance, and it's unlikely that you skipped it. And to me as a broker, I typically like that question because it gives me a chance to hit objections head on, and I can almost lay out the objections that I know of right there and curb them and or not curb them, because sometimes it is what it is, and it's just that's the asset and this is the price and that's why it's the price. Sometimes that it's that simple. But it gives us the opportunity to do that. I would say it's not the most frequent question we're asked. It's maybe from 10 to 15% of buyers in some way, but it does pop up more on tours. when you're touring, it tends to come out more naturally as people are walking in one form or another. But to your point on phone calls, it's probably less than 20% of the time. It's pretty rare.
Thank you.
Yeah. Steven, it
Steven.
looks like
Yeah, you got your hand raised. Go ahead.
Oh, we
Oh,
lose
we
him.
lost him.
Hey,
I've got a
TJ.
question.
Thanks
Oh,
for calling on me. Similar to Deontay's question, so I have it's not a deal yet, but I have a broker send me a portfolio, and the seller was willing to sell them individually. And the one property I was interested in, it's a newer build versus the other ones. And so I started like looking into it and doing some number work with it. And then I have another broker and I was talking to about another deal and it's in the same city. And I just asked him because I was like, so have you heard about this property, and the sellers from this property? And he recognized it and he's like, yeah, he's having a tough time selling his stuff or blah 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 blah. But when I asked the original broker who sent me the portfolio, um, they said that he was selling his assets to take the equity and put it into a larger investment. So it just seems kind of fishy. And I don't know if the second broker was just telling me that because they didn't get that asset, that property to sell for the seller versus the other broker that's kind of like hiding something. What are your thoughts on that from a broker standpoint?
Yeah, a few things. Could go a lot of directions there. The first one is there actually could be truth to both. There's a good chance that the seller expectation is high. A lot of sellers have high pricing expectations, right? Sometimes that's not true, sometimes it is. And then there's also a very good chance that even if it's not a huge win, that they're done with the opportunity and moving the equity into something else. So it's very possible that you're hearing two different spins of the same story. And there's probably some motivation on both sellers or both brokerage sides to present the same story in those different ways, and or parts of the same story, right? So very rarely is it truly a lie from a broker, but there's some out there. Like there's bad in every industry, but there's always an angle, right? There's likely some level of representation from the broker that sent you the deals, potentially on the seller side. So they're more motivated to tell you a seller favorable story. And the other broker, a lot of us try not to be this way. Some don't care. A lot of brokers will just go trash other brokers' listings, and it's just what they do and how they try to take down other brokers. So really hard to know without knowing the personalities at play there. They could both be being perfectly ethical, and there's very far extremes that both of them could be on there. But at the end of the day, there's a lot of different motivations and factors that could be at play in that particular instance. But yeah, certainly not shocking to hear two different narratives from uh, folks of varying perspectives on the deal.
Thanks, TJ.
There was one question in the chat. So you would not suggest going into a C location?
Not necessarily. I would say that, well, I mean, personally, I have been a GP and am a GP in a deal in a C location right now, and I've LP'd into deals in A locations. Like, I I'm agnostic. I try not to. I really don't invest in deals unless I'm not involved in them. I am a broker first, career wise, but with my own money, I am certainly in both locations, in both extremes, and I would do a B deal. I'm agnostic to deal profile on a personal level. I very much think that it depends on what your goals are. If you're in a cash flow heavy focus right now and you want to buy cash flowing deals, see locations and see product might be the best place for you to look. Now, if it's your first deal and you don't have a lot of operational experience, maybe that's something you need to think about avoiding. But it also could be where you get your hands dirty and find your first deal. It really depends. Um, but you can find some really outsized cash on cash returns in C locations right now. So just because every buyer in the marketplace is doing it doesn't mean you shouldn't do it. Uh, but there's a reason groups aren't buying in C locations. That's where cap rates expanded the most. And so a lot of groups that bought in C locations 2, 3 years ago are getting burned worse than groups that bought in more A locations. So there's a lot of different perspectives on that in the marketplace. But kind of going back to the metrics thing that I mentioned earlier on, how you may be 70% off on one deal and right on the guidance at another. If you're sticking to your metrics and you know what you want to buy, it will help you determine which deal is best for you. But if you're looking for cash on cash right now, I actually don't think C locations are a bad option, potentially.
I'm going to assume that answered your question. Anybody else have any questions before TJ goes into his next section? Yep, it answered her question.
Sweet. Well, we won't be rigid. If anybody thinks of other market questions or scenarios they want to talk about, we can dive into those here at the end of the next section as well. But we'll go ahead and get going here into the commercial broker section and just some high level thoughts for you guys on brokerage in general. So one thing that's really interesting is you hear this term broker, commercial broker, as opposed to agent or realtor. And it's a formality. I don't think many brokers really care if you call them an agent or a realtor, but it will make you sound less experienced in the commercial world because commercial agents have always been referred to as brokers, even if they don't have a broker license. I'm in the rare camp of people that did the extra licensing with the state so that I could not have to hang my license. And now I still do and actually don't act as a broker in its traditional mindset. But generally speaking, the term, I'm not 100% sure where the origination of calling us brokers as opposed to agents came from. My presumption has always been that we're brokering investment sale transactions. So the term broker is more important. We're not necessarily an agent to a buyer. It's the agency side of the relationship is less important than in residential, although it still matters who we represent. We need to be formal and upfront about that. It's just there's not an agent on every side of every transaction anymore. So a lot of times you're brokering the overall investment sale. And then also another difference and key difference is that this is a more metric driven market. We talked about this a lot over the questions here. But folks are looking at yields. They're looking at IRRs. They're looking at cap rates. They're looking at cash on cash. They're looking at yield on cost. Groups are certainly looking more at metrics than just comps. The comp is really the metric in the single family space, that and your monthly payment. And so it's just a more dynamic market with more factors. Generally, it's more fact than emotion driven, although it's still a human business, less emotional than maybe buying a single family home, but there's still a lot of money involved. Most of the time, a lot of the principal is personal money. So still a lot of emotion involved, but less emotion driven in the business. And that's why this metric drive as opposed to emotion is why values changed so quickly in multifamily when interest rates changed, whereas in the single family space, I mean, there's many other factors, but one huge factor is that people still care about what they buy and people didn't want to lose money on their single family homes. And so that's been a slower space to adjust pricing as interest rates changed, whereas a metric driven market like the investment sale and commercial market was much quicker to adjust when interest rates changed. And then it's just more sophisticated players, which is where I was going with that agency side of it. Most buyers don't have a representative once you get into a big enough deal size. The expectation is that there's enough experience amongst the buyer team to at least understand what they would want to buy, and generally represent themselves in some capacity. You're typically going to have legal representation. And sometimes if a broker finds you a deal, you may be paying a buyer broker fee. But there's certainly less need for the broker to hold your hand through what closing costs may be and help you do your escrows. Not that we can't do those things, but it's less of a need typically for the buyer groups and even the sellers in a lot of circumstances. And so our role becomes a lot more around knowing everyone in the market, knowing the participants, knowing why capital is flowing and what it's doing, and really understanding the operations of the assets themselves and giving you good guidance on what's happening in the market. Because at the end of the day, you as a principal, might close, I don't know, you'd be a really active principal to close 2 or 3 deals a year, maybe even one the last few years when transaction volume was low. And, us on the brokerage side, we closed 20 just in the Kansas City metro last year. So there's just a lot more real-time feedback, a lot more activity. We're having a lot more conversations day to day because talking to folks like you is our job. And, we're just in tune with the market and can give you a lot of value and insight into what's happening around you, to things you might have blind spots to. But it's not the same level of hand holding and filling out a contract form for you, and just generally educating you on how a transaction works like a single family realtor is. So those are some of the biggest differences between the two. If we want to get into things to keep in mind now on communication. So this is where a lot of people go wrong, is just actually communicating with a broker. There are a lot of groups that sign a CA, get in the deal room, get the email blast, maybe respond asking for price and guidance, and then they go dark, which is totally fine. You're not obligated to give a broker feedback. You're not hurting our feelings not giving us feedback. It's not about that. But the constant communication, and when you're giving good responses and picking up the phone when we're getting close to call for offers and letting us know why you're not bidding, if you're not bidding, and letting us know what you want to see in the next deal. Those are great things for you to do because it builds the relationship for one, it keeps you in our minds, but it also helps us cater to what you want going forward. And when you're signing CAs and bidding on deals and coming and touring and taking our phone calls, all those activities and communication may seem repetitive and like a big use of time on each and every deal, because they are. But that's what keeps you forefront in our minds, so that you're the first to see the next deal. You're the first to see the one that's relevant to you. You actually get thought of, because you're on our minds. We just talked to you. We can't forget about you when we talked to you a day ago. But if a quarter goes by and we haven't talked in 3 months, you haven't been active in the market, and someone else has been talking to us daily, daily is probably an exaggeration, but on a few week basis or even monthly, they're going to be front of mind, and they're going to be the person that we think of. And among being active, actually buying. Once you own a deal in a market, it shows a level of being real, and an ability to close, which will help you get more deals, and see more deals and be more front of mind. You also become a prospect for a future sell, which doesn't hurt in getting more attention from brokers, to say the least, because many of us, that is our primary business, is seller representation. And so all those things help you get more looks. And so being active is probably the biggest takeaway for maybe the whole presentation tonight. Being active in your communication and bidding is huge. Be patient. I talked about this a little bit ago. I mean, there's only so many deals that trade. And so it takes a while to find the right one. And, some of our calls might be less productive than others with each other. You might rule out everything we've got on market, but at that given point, but inventory changes quickly. So just high levels of communication help you know what's coming down the pipeline, and what's out there, and keeps you from missing a deal because there is only so many. So be patient and stick it out and stay heavy on the communication. And this last one, I'm going to go into multiple examples, but doing what you say you're going to do as a buyer and principal in the marketplace is huge. There's many ways that people don't do what they say they're going to do that negatively affect them in the future, sometimes without them realizing it. And a smaller one might be you don't end up offering like you said you were going to, which is not the biggest deal in the world. But that's maybe a starting sign to a broker. Like, okay, they said they were going to offer it, 17 million bucks on this $18 million deal. And, it would have been another bid in the summary. That would have been great. And they just decided not to. They went ghost mode on me, haven't heard from them since they made that indication. That's not going to be a killer for the relationship long term, but it's something that gets noted over time because next time you say you're going to bid, if it's a deal you really want, we might not be taking that as seriously, right? Because you kind of left us at the altar last time. But that's a small level one. What the much bigger ones are, when you ride an offer and then all of a sudden you're not ready to perform. Maybe you don't have the equity to perform on the offer you finally win, right? And if that happens, that certainly can be a big problem for us because we represent sellers most of the time. And if we go around doing deals and bringing buyers to deals that don't close, it is really hard on our reputation as a broker in the market. And a lot of times as brokers, we're only as good as the buyer we bring in the seller's eyes at the end. So that trust and that consistent performance from a buyer certainly earns you deals in the long run. And that's trust in doing what you're say you're going to do and actually close, but also in the negotiation and potential retrade process at the end of a DD. If you're asking for money off at the end of due diligence on every deal you do, that's going to become part of your reputation and is going to be something that makes us avoid you as a bidder. So all those things really impact the perception by brokers in the market. And one last note on that before I change slides. Just because a retrade or a deal getting dropped happens with one broker or off market with the seller, it doesn't mean the other brokers in the market don't know about it. You would be shocked at how much knowledge and background the most active brokers like ourselves and over at MMG in the market have. I mean, we are talking to likely your seller. We literally BOV to over 60% of the deals that have traded in the last year in Kansas City before they went to market. So we know the players in the market. And even if it's not our listing, we're following up with them because if things go south and that deal doesn't close, we still want to be there to potentially take over a rebound sale. And so we probably get the insight to the good, the bad, and the ugly that happens in that transaction. And so just be cautious. It's a small world and things do travel quickly. And you'd be shocked at what gets around and what people end up knowing about, even when you try to keep things on the down low.
There's
Jason,
before you jump to your next slide, there's a question from Kevin here.
Yeah. What you got, Kevin?
So what you're saying is there's a great big coffee lounge where all the brokers hang out and chat.
It is that is a great question. And it's actually not as much the broker to broker conversations. It is the principal to principal conversations. There's a lot of ex-athletes in this industry and a lot of very competitive minds on the broker side. And I can tell you that while we'll be cordial at some industry events, we're probably not hanging out on the weekends. And there's not much of a coffee lounge between the brokers, but there is definitely a water cooler amongst many of your other peer buyers and principals in the market and with brokers. And so we're getting intel from them more so than brokers, but there's some of that too.
All right. I didn't want to take it into the gutter, but anyway,
Yeah. No, that's good.
This is phenomenal. This slide is phenomenal content. And I'm intrigued by the well, first, you're your candid conversation here, and I think that a lot of people would benefit from this. In fact, I may have an offline conversation with you about speaking with some people I know, simply because the environment we're in and the ecosystem that several of us are in here, a lot of people are brand new to this market, so they're as novice as it gets. And I frequently let people know, listen, brokers are humans too, right? And there's that whole, how do I approach it? There's the mindset of fake it till you make it, which I just abhor. So my question is, how do you feel and what would you prefer the interface to look like with someone who's absolutely green as they come, coming into this with a pure heart, wanting to do it, is in the middle of learning, and they're calling you? How would you like to interface with that person? What would you like to see?
It's good to know that on the front end, because we can easily accidentally probably speak in what feels like a foreign language to you and just make the conversation less productive, right? Uh, and so that's maybe number one is knowing that. But the biggest tip on that front is if you're a newer person to the business, be partnered up with somebody that has the ability to do the deals and is there with you. Because if you're doing the deal with a good partner that's a known entity, that's closed and is proven, that's going to help your chances a lot, because it is hard as a broker to bet on a first time buyer if they're not working with somebody with the backing, right? So maybe even to that first time person, assuming you're doing a lot of networking and are connected with a group that you're going to take down deals with, uh, acknowledge how you're going to take down the deal and give yourself some extra credibility by talking about who you're sourcing this deal for and with. Because if you're doing it with somebody else, tell us that, because that's going to give you a little bit more of a leg to stand on in a bid
Right.
summary with other folks that have bought deals before. Uh, so that can help right there get taken more seriously if you're able to project why you should be taken seriously. Uh, because it's okay to sound new. I mean, there's plenty of really sophisticated firms out there that hire analysts with borderline no real estate background that are talking to us about deals, but they're going to get taken very seriously because they're at a group that owns thousands of units, right? So
Sure.
trying to leap yourself in with as much experience as you can, even if it's not your own individual experience, is probably the biggest tip that I could give somebody there.
Yeah, I appreciate that. And I think it's really just about that first call that people, it's the butterflies, right? And
Yeah.
I mean, I'm going to just ask you this straight up, and this is, how do you feel about people? I mean, how transparent is it to you when people are trying to do the fake it till you make it thing? Just for my entertainment.
Yeah, that's a great question. Certain people are better at faking it, so it'll make it longer. It doesn't usually make it past the full conversation. But if they've got the right script, maybe they make it, through a couple questions, and then as soon as, uh, and look, if it's a newer broker, they might not even pick up on it. But as soon as a more experienced broker gets to the point where they're turning the questions back on this person that they don't know, and it's not even an aggressive thing, it's just a natural thing that as an experienced broker, you start to try to qualify and quantify who you're talking to. And it makes you more relevant to them long term. So there's going to be these natural questions back. And it's usually about that point in the conversation when the questions start coming from the broker side that they either kind of run from the call, which then, that doesn't create a lot of follow up for us because we didn't get to know them, or two, the the answers start to show the immaturity, right, pretty
Mhm.
quickly. So usually it doesn't make it past the first conversation. It's pretty hard to fake it if you have no experience, right?
So I appreciate that, and I have one follow up, and then I'm done. So how do you feel about someone who would call you and say, "Hey, thanks for taking my call. I just want to let you know up front, I'm brand new to this game, blah, blah, blah." How would you feel about that?
It's perfectly fine. I'm probably going to ask some questions and understand where they're trying to go and how they plan to get there. And if that's
Right.
not developed, I'm happy to spend time because that person could be a lot of times people become real players later and they aren't yet. And so
Bingo. Bingo.
most brokers are cognizant of that and have seen that happen in their own business. There's groups that when I was growing as a broker and selling 20 to 30 unit deals as my baseline, and those were big deals for me at the time. I can think of one group in particular that was buying those deals at the time. It was their first couple in Kansas City. I think they might have bought their first one in Kansas City from me back then, either that or their second. And they grew with me. And, they own thousands of units now, and I've transacted with them many times on larger transactions. And most experienced brokers have some sort of client like that they watched grow into a more relevant client over time. So most of us are fairly open. Don't be offended if we're having a busy day, if we spend a little less time on that call. But at the same time, we're going to be open to it, especially if you've got a plan of attack on how you're going to take a deal down. That's going to get you more time. But most brokers, are going to protect their time at some level, but also try to
Sure.
be respectful. And so the more you can come with a plan and explain how you can act on deals, the better off you're going to be.
Perfect. And I hope that's helpful to people on the call, because it's all very human.
Yeah.
Right. And I appreciate that. So, all right.
You
Thank
got
you.
a lot of good questions, Kevin. Good questions. Christian, do you want to ask your question in the chat here? Because it's a long question, and I don't know if I understand it.
Christian. Oh, there you go.
Just got to unmute yourself, and then you can.
Yes, hello, can you hear me?
Yep, can hear you now, sir.
Hi. So yeah, no, that's great. I've been picking up so much, but one of my questions was, say you're communicating with a broker and you get details about a certain deal or something, and you ask him if he's got any other deals to offer, what other deals he has, and they don't have much more to offer. Is that something to pick up on as? Is that common, or are they just kind of closing that conversation out because they picked up, say, someone that's green, or like, you know what I mean? Like, is there, they just don't want to show you? Is that a common thing that sometimes they'll have moments where they won't have that many deals to offer?
Yeah, it could be both. And
You know, like,
uh, every broker's had a point in their career where their deal pipeline somewhat dried up. And if a buyer's pretty specific on what they want, a lot of times we know that we don't have anything in the pipeline that's an immediate fit for that person. So that can be the reason we're ending the call quicker. It can be real. It depends on the level of broker, and it'll probably take you time participating in that particular metro to understand which brokers are constantly having inventory and which ones aren't. There's plenty of folks closing a small enough number of deals a year to have times where there's not a lot to talk about, especially younger brokers in the business. But sometimes they're going to have deals that are worth chasing. So it could mean a lot, and it's again one of those questions where it's just hard to know without the situational context. It could be a reason to get off, but it also could be real,
yeah,
especially.
no,
Yeah, go ahead.
yeah, and I appreciate that. Yeah, I just wanted to see if there's like something like, okay, we maybe should look for another contact that maybe is more more active or something, or he's just not feeling you. But yeah, I understand what you're saying. They sometimes they just, well, that's what they have at the moment compared to what you're looking for specifically. So it doesn't necessarily mean you need to find another contact or another broker to work with or something.
No, because it ebbs and flows. Even for the most active brokers in a market, we might go from having 3 Class A deals and 1 C deal to 2 C deals, more of a B deal, and nothing in the Class A space, or vice versa. And that's just
Yeah.
always fluctuating, even as a very active broker.
Okay.
So yeah, a less active broker might really have no deals at the moment to talk about.
Right. Right. Yeah. Okay. All right. Yeah. No, I appreciate that input. Thank you very much.
Yeah, absolutely. Well, I'll round it out. I've got one last slide on the brokerage piece here, and then from there we can close out any questions and all go on to enjoy a weekend here.
That's right.
So how can a broker be a resource for you? That is the closing piece here. And number one, we talked about market knowledge. Hey, pick our brains. I'm happy to have a market update call that's not even focused on deals. That's something that a lot of really good high level acquisitions people do frequently. They'll call just to talk about the market with us. Usually we'll get into deals at some level in the conversation because that's what we're all here to do. But pick our brains. Pick up what's happening in recent sale comps. Pick up what's happening in trends. You can get a lot of the market update that I just talked about in a month from me in the newest form and with the latest data. If you called me in a month, I'll be ready to do that. Um, we can also talk about rent comps on your personal assets. So some of these are getting more into once you own a deal. But once you own a deal, we have endless amounts of data. We've got entire research teams at most of the major shops that are happy to pull data for you, especially here at MMG. And rent comps could be on acquisitions too, and so can expense comps. But a lot of times people are asking us because they're trying to understand where they're at within the comp set at the moment. So we pull down a lot of Yardi or CoStar data and things like that for active players in our markets. I will say some of this stuff gets pretty intensive labor-wise for us. So, until you own real estate, it might be a little bit bigger ask for certain requests, depending on how much research you want and how frequently you're asking for it. But especially for established owners that we want to list for long term, there is just an endless willingness to give free data from most of us brokers to earn the business long term. And we talk about expense comps. We talk about how other groups are operating. I mentioned, we BOV'd over half of the deals that sold in the market last year in Kansas City. We can give you really good feedback on, how other groups are operating from an expense perspective, et cetera. And then when you're, looking at your deals and trying to understand your portfolio, we do a lot of real evaluations and valuations of real estate prior to sales, sometimes years in advance of sales. There's a lot of very sophisticated, large ownership groups that have us value their deals on an annual basis just to keep a pulse on where the deal values are, even though they have no interest in selling in the short term because of fund lives and things like that. But they just try to keep a pulse on their current values. And within those evaluations, the reason I'm calling them an evaluation, not just a valuation, is we're going to give comp updates. We're going to talk about expenses with you and talk about long-term strategy for the real estate. And beyond that, we just spend a lot of time advising clients and talking about future sales. So if you're planning to sell a deal in 18 months, probably a good time for us to be talking about value now, because that's when we can give you those rent comps and expense comps to help you start planning for a sale. A lot of times groups come to us right when they want to sell and ask for a value. And if they would have come to us 6 to 18 months earlier, we probably could have given them some advice on where they need to move rents to get to their target sale price and things like that. So evaluating deals early is a very common practice and smart thing to do that a lot of clients don't exercise. So definitely something we do often that not everybody uses us for that I'd recommend. And then look, we'll do custom research for you. Like I mentioned, we've even had clients ask us in certain submarkets, how well are washer and dryer in unit received? What's the delta in rent for a unit that has a washer and dryer in it? And we've done custom neighborhood comp polls for them and done very custom forms of research like that for different buyer groups and owners in the market. We can also make introductions to key players. We know who's the most aggressive on insurance in the market at any given time and can make broker introductions on that side. We know who the best lenders are. We know who's managing properties on the third party side the most actively for the types of deals you want. And so pick our brains for those industry contacts. A lot of times that's free data for you. And then the obvious things, right? We're always happy to help you sell deals, send deals your way and source deals. Those are the obvious ones to end it out. But, I think we're underutilized on a lot of those other ways. We can be a resource. So, that's what I've got. I'll leave this last slide up with my contact info for a minute here. You can find me on LinkedIn. I've got a 6-letter name, so hopefully you can write that down too if you want to look me up later. TJ Wall's, nice and short. So feel free to look me up online, shoot me an email, text, phone call, anything, and happy to connect and help you with any other specific cases. I think we talked about a portfolio that's probably better deeply discussed offline earlier, things like that. Happy to talk to you guys and continue to be a resource outside of just what was said tonight.
Yeah, this was awesome. Any last questions that you guys might have for TJ? I mean, again, thank you, TJ. This has truly been awesome. I mean, there's a bunch of great comments in here while you were talking too.
So
And
Sandra has a
Sid,
question.
Yes,
Sandra.
hi.
Oh yeah.
Hi. Thank you for
Hey.
having this. It's really helpful. I just have a question. So I'm in Los Angeles, California, and let's say there was a property that was listed for 12 million, but then after doing all the underwriting and my expenses are a lot higher when I go into, let's say, own the property. How offensive is it if I like put an offer, let's say at 8.5 versus the listing price at 12 million? How do you feel about those type of offers?
Yeah, it's a great question. Very situational again, because if a deal is being purposely guided high, certain brokers, certain markets, uh, certain timing within a market cycle, brokers will guide higher on purpose, or
Mm,
maybe they're guiding lower and trying to get people to bid and then drive bids up from there. Sometimes they're trying to put a higher whisper out there so that there's a perceived discount in the market from what the original purchase price was. There's all sorts of optics around pricing. And that's part of why pricing guidance is so common in the commercial world, where we're not giving an exact number, is because it is more of a target range than an exact price, because everybody's going to have different metrics. And so, generally speaking, a low bid is not offensive and
mhm,
not something you need to be scared of doing. As you get outside of, call it, 15+% off, it can seem like an astronomical gap. And asking the broker realistically if they even want that bid is sometimes a really fair question, because there's groups that just submit low bids all the time and kind of get that reputation, and you don't necessarily want to have that reputation um, within the brokerage community. But they'll still sell you a deal when it's time, so it's not going to hurt
mhm.
you too much typically. um, but asking the question, like, is this embarrassingly low? Do you not even want to present it before you actually write it? Because once you write it,
Right.
typically we're going to feel an obligation to present it. um,
Okay.
it's a conversational piece there typically to figure out if that's worth your time or not. And sometimes we need the lower bids to show a seller where the market's coming in on their real estate too. So
Mm. Okay. Thank you. Thank you for your time too, everybody.
Yeah, great question. Satori.
Okay, so my question is, I have a lot of clients from Europe, and they're trying to come in. We're trying to bring them into like through an SPV fund, and want to know like how do you as a broker see those kind of deals? Does it complicate things for you? Does it not matter?
so SPV fund, maybe explain a
Like a
little bit
special
to me.
purpose vehicle, I guess like a feeder fund.
Got it. So it, a lot of fund structures can actually be a positive, because if you have a fund pre-raise, or at least some level of capital pre-committed, that does actually help qualify you as a buyer, because that's actually a slightly stronger uh, equity position than a typical syndication where none of the money is in an account yet, right? Or only the principal's money is there to start at the transaction. So even with great experienced syndicators, there's the risk that that particular raise doesn't go well. So a fund's typically going to be viewed favorably. Is going to have some sort of benefit in a bidding process. But a fund that doesn't have a ton of experience versus a syndicator that's closed a bunch of deals, is still not going to be an advantage. But generally speaking, it is a stronger equity source than a syndication model.
Cool. Thank you. Appreciate it.
Good question. Any last questions before we let TJ go? I always like to give it a little bit because there's always a delay, right, between your headphones and the actual content. All right. Oh,
Yeah,
wait, Christian.
Oh, go ahead.
What, Christian, and then Tim.
Okay, yeah, one more quick. I want to touch on something. So I went to one seminar, a summit in Scottsdale of Grant Cardone's, and so he was talking about when you talk, some are at a disadvantage regarding their when they have their accents or certain stuff like that. Now, how true is something like that, that some would have more advantages when you talk to a broker if he feels that you are not quite as skilled? Because he was mentioning something like that. He said this is something that's very, this person right here may get more deals from this same broker as this other person would call if he would call, because of this barrier languages or something along those lines. How true is that for, I'm bilingual, but I speak English somewhat fluently. But is that a barrier for certain people coming into this field as well?
I suppose it could be if you're an unknown entity, just
It's
because of
not a
the
common thing.
communication aspect, right? There's the
Right,
human
right,
side. But if you can understand somebody and qualify them, there's no reason to not transact with them. You're doing your seller
right,
a
right. I mean,
disservice, yeah, at that point. So, no, and seeing deals is no, it's going to come down to more of a track record problem than I mean, there are plenty of non native US citizens that buy deals from us every year, and plenty of very different cultures than a Midwesterner that grew up in Kansas City like myself that buy deals in Kansas City. In fact, that's probably less than half, maybe even less than a third of the buyer pool that's truly from the same region of the country as me. So, especially for us Midwest brokers who are used to East Coast capital or West Coast capital, very different religious backgrounds, plenty of very much international equity coming into our markets. We're not going to be hiding deals from somebody over a language barrier. The disadvantage would just be in the communication side, and if we can actually understand what you want. So as long as you're able to articulate what you're looking for, I wouldn't expect that to be a huge
so it's more of
disadvantage.
how knowledgeable you are on in your field of work, regarding what you're looking for. The more knowledge you have, the better chances you have of getting more offers, more deals. Correct?
Yeah, yeah, because
Right.
we're used to talking to people with very different cultural backgrounds than whoever's on the other end of the phone, because there's so many different backgrounds playing in this space.
Well,
Yeah. So I wanted to touch on that because when he was touching on that, I was kind of not understanding what he was meaning, because regardless, if you have I was thinking, if you're quite knowledgeable on in your field of investing and stuff, and you know your stuff, what you're looking for, and you can communicate, the language barrier maybe it shouldn't really be an issue. I wouldn't think.
Christian,
Yes.
in that same sentence, Grant will also say that typically brokers favor men over women as well.
Right, right. So yeah, something along those
So
lines is where I was trying to get at. But it's not really so much as quite like literally where he was referring to.
maybe some of the brokers he's dealt with, I don't know. Like you
Perhaps,
said, they're
perhaps.
all human, they have their different
Right,
biases. But
right,
I
right.
think that regardless whether you're bilingual or you're male or female, if you're knowledgeable, you're going to have a great relationship with the broker.
And it's probably
Right.
different in the different parts of the country and different markets as well. So,
That's true. That's true where you're at. It depends where one is at. Right.
Yeah,
Okay. I appreciate that.
I would just add there that once you get to transaction sizes of, 5+ million, probably, the any given deal's likely to have multiple different equity sources in it. And when it's not just one individual, it's likely to not be local. And so when you get into larger deal sizes, you're talking to such a diverse group of individuals and buyers and women and men. You're paying way more attention to the substance of what they're saying and the
Business
quality
standpoint.
of what they've done in the industry as well, and their track record than anything that's coming through is from a voice standpoint.
You need to establish that track record is really important.
Right. Much more important than any physical perception
Right.
or
Okay.
audio
Thank you for that info. I
perception.
appreciate that input. Yeah, thanks for that information.
Yeah, I just wanted to add, I just kind of want to give a shout out to TJ and MMG. I'm in the Kansas City area, and they are, in my opinion, they are probably the number one broker as far as especially multifamily. Um, and I tell you, I dealt with TJ, I've dealt with three or four other people out of his office. Is Jake in your office, or is he in
Yeah,
St. Louis? Okay.
he sits in Kansas City, but he works
Yeah.
nationally. Yeah.
So Jake and Colson and Parker and TJ, I've toured properties with all of them, had conversations with them. And I know some of you on the call have probably heard some, just, to be wary of some of the things that some of the brokers tell you, but I can tell you these guys are straight up, they're honest, great to deal with. So they've been a pleasure to work with, even though they haven't given us a deal yet. But I
Well,
think they've been pretty straight shooting with us. So
and I appreciate that, Tim. We have done deals with Justin though, so
yeah, that's
Yes.
right. That's right.
Yes.
at a distance, we have worked with you guys.
Right. Right.
So
But
it's the 6 degrees to TJ. That's what it
Yeah.
is, right? Yeah. Awesome. No, again, really appreciate this, TJ. I think everybody on the phone loved it. There was a ton of comments in the chat about how helpful this was. It is recorded, so we will post this on our YouTube site and send it out to you guys as the recording. So really appreciate all of you. I mean, Friday night, big deal. Usually everyone wants to go out and hang out, and you guys are here learning, so you're definitely on your way. So I want to thank everybody for joining, especially you, TJ. Appreciate you. You might have a bunch of folks reaching out to you too.
excited for it. Thanks for having me on. And look, I know everybody gave up time on their Friday night to come sit on a call and listen to me primarily. I don't know why you do that. No, I'm just kidding. But no, I really am honored to have everybody's time tonight and hope you guys found some value and
So that's
look forward to connecting. Yeah.
so I would encourage anybody that calls him as a result of this call to remind him of that. That'll prove right there how dedicated you are, just because you were on this call on a Friday night.
That's right.
True.
That's right. And we tell them all the time, not sure why they want to spend their time with us, but they do. So again, thank you all. Hope you have a great weekend, and we will see you all next Friday.
Thank you, TJ.
Thank you,
Thanks,
Thanks,
guys.
everyone.
TJ.
See you.
Thank you.